Global recessions are rare. We've had only 5 since World War II. They usually happen when major economies like the US and China slow down together. But here's the twist. They don't hit everyone the same. In 2009, the US and Europe economies shrank, but China's and India's economies still grew, even in the middle of a global recession. So what counts as a global recession? Let's break it down simply and quickly. The definition of a global recession by the renowned IMF, the International Monetary Fund, is a global recession happens when global GDP per person falls. So what is global GDP? It's everything the world makes: goods, services, investments. Divide that by the world's population, and you get global GDP per person, basically the world's average income. If that number goes down, people everywhere, on average, are getting poorer. Why global recessions happen is more complex, and that's what this video will cover. Historically, that drop in GDP per person has ranged from 0.5% to over 3%, which are small numbers, but on a global scale, they're massive. And that definition matters, because the IMF is the world's main economic watchdog. But the IMF doesn't stop there. They also watch global trade, factory output, and jobs. And if those are falling too, that's when it's clear the world is in a recession. Here's the catch. For a single country, a recession is usually defined as 6 months of falling GDP. But for the whole world in a recession, there isn't one simple rule like that. It's a mix of signals, which is why people sometimes argue about whether the world is really in a recession. And why do global recessions affect us all? Because when it happens, it hits your wallet, your job, and your future. To see how this plays out in real life for everyone, let's rewind to the 2008 global financial crisis. It began with the US housing bubble. At first, house prices soared and greedy banks gave out risky home loans, called subprime mortgages, to millions of Americans who couldn't really afford them. Those loans were bundled into investments and sold worldwide to banks and big investors who thought they were safe. But when many homeowners stopped paying, demand dried up and repossessed homes flooded the market. Those mortgage investments lost value fast. Banks in the US and Europe had bought huge amounts of them, so suddenly no one knew which banks might fail next. But it didn't stop there. What began with bad loans in America was about to shake the entire global financial system. That's when stock markets crashed. As banks revealed massive losses, confidence collapsed and panic spread worldwide. Credit froze, leaving businesses unable to borrow, families unable to get mortgages, and investors expected companies to make far less money. Faced with that reality, banks and investors rushed to sell before prices fell further. Within months, global markets lost nearly half their value. Retirement accounts and pensions tied to those markets shrank by 30 to 50%. Years of savings gone in months. Sadly, factories slowed, exports fell, and millions lost jobs. Exactly the kind of global trade, output, and job losses the IMF uses to mark a worldwide recession. The 2009 global recession is often blamed on the US government, and for good reason. Weak American regulation let banks hand out risky mortgages and sell them worldwide. An interesting fact is European banks weren't innocent either. They borrowed heavily to buy the same risky US mortgage assets. When those collapsed, their losses were massive. And because finance was so interconnected, the damage spread quickly. Banks cut back on lending, trade financing stalled. As the US and Europe bought less from abroad, exporters from places like China to Brazil were dragged down. But Beijing launched a massive spending program that kept its economy growing nearly 9%. India also kept expanding, thanks to its banks avoiding toxic assets and an economy less tied to exports. So, that's what a global recession is: rare, powerful, and world-shaping. And here's why you should care. Whether you're in New York, Beijing, or New Delhi, when these economic giants stumble, the ripple effects reach your pocket. And here's the big question: which economies actually drive these downturns? We'll dive into that in the next video.